Hi, this is Johnny, your friendly local realtor, here to bring you the up-to-date housing market report for May 2022. As we're headed towards the summer season, we're seeing continuing buyer activity in the market, but are all these buyers making the right decision? I mean, how can you be sure that the home price is not going to fall? What if this is a bubble and it's going to crash like in 2008? With the sudden rise in interest rate that happened recently, many people think that this is the beginning of the imminent crash. Today, we're going to delve deep into this as well as other important issues that are up ahead. Let's get started. It seems like it's almost impossible not to read or hear about the bubble when the subject is about the housing market in the news today. So, in finding out if we're in the bubble, let's start by looking at this graph. This graph shows the home appreciation value going all the way to the end of World War II. The reason I'm going this far back is because modern day housing boom started right after World War II with the new GI Bill in this country. This GI Bill provided education and also provided the ways for the returning GIs to buy homes. And ever since then, up until now, there's only been one time in our country that had a dramatic fall in home value, and that was 2008. And there's really two reasons why we lost home values then. First is because we had loose lending standards. Banks were lending to everybody, not checking for borrowers' incomes and jobs, and almost no verifications. And the second reason was cash out refinances. People took out equities they had and spent it lavishly on things like new cars and vacations, really financing their lifestyle, thinking this will never end. And of course, all this irresponsibility ended very poorly. So remember, there was only one time that home values fell significantly in our country after World War II. Now, keeping this in mind, let's compare this to what's happening right now. What we're currently hearing about the bubble and housing crash is coming out from the past 2 years with COVID. And do you remember the forbearance program that helped people with their mortgage payments during the pandemic? Well, originally, experts had expected that 30% of all mortgages in the country would claim forbearance, and all of those could possibly turn into foreclosures. But what actually happened was that only 8.47% of all mortgages registered for the program. And that number is what you see here in May 2020 at 4.76 million. However, as you see from the chart, the numbers of people that had registered and/or was engaged with the program have been leaving the program since its initiation. And last month in April, the numbers that are actively engaged with the program have been dropped to 690,000. And of course, we can anticipate that this number is going to continue to drop. And what's been happening to those people coming out of the program? Well, as of March 31st, 2022, 37% of those people have paid their mortgages in full, meaning some people originally signed up for the program as an insurance. Some of these people completely paid off their loan, and for some, their past dues are brought current and are now back on track. 44.6% have worked out a loan modification or deferral with the bank. And these are all positive signs. But about 18% of them are in some sort of trouble. They don't yet have the loss mitigation plan, and I really can't say what's going to happen to them. But regardless, this is not a huge number, and if all these people can't find a way to continue paying for their mortgage, they have many options available today. With home price appreciation that we saw in the last couple years and overflowing numbers of buyers in the market, all you need to do is to simply sell your home. I mean, isn't this what you would do if you were in that position right now? Would you really walk away from all that equity? So, understanding why we had the housing crisis in 2008 and understanding what's happening right now with the forbearance is critical in knowing whether we're in the bubble and headed towards a crash. In regards to this, Daniel Hale at Realtor.com said it like this: "We have learned from history that prices can fall. The more important question is if it's going to happen right now. And that's hard to say." Meaning it's hard to say it will happen this time because things are very different this time around. So what's different than in 2008? Like I've mentioned in the beginning, one of the reasons for the housing crash last time was due to loose lending standards. If you look at this graph, this represents lending standards going back to early 2000s. And there's really two factors to this. First is the product risk, which were the types of loans available to people in the red portion of the graph. This number peaked at the onset of 2008, and you can see that this has been completely eliminated now. The orange part of the graph representing the borrower risk, is basically the asset profile, credit score, and other things that are needed to qualify the buyer for the loan. This number also peaked right before the crash, and you can see it's gotten a lot stricter now. And this coincides with the numbers of foreclosures as you see in the next graph. Where we are now, we are at all-time low in numbers of foreclosures. And compare this to the times during the housing crisis where the foreclosure numbers were at millions. Of course, in the last couple of years, we had a government moratorium on foreclosures during the pandemic, but what I want to point out here is that tighter lending standards leads to less foreclosures, because highly qualified buyer is much less likely to default on the loan. So the loose lending standards, one of the major contributors that caused 2008 is no longer around. Okay, but aren't the home prices going up? How is this going to affect the people's ability to support higher debt? Isn't this going to be a challenge? Well, take a look at this data by Federal Reserve. This is the Household Debt Service Ratio for mortgages as a percentage of disposable personal income. Simply put, this shows how much of the people's after-tax income is being spent towards mortgage payment. As you see in this graph, during the height of the housing crisis, the mortgage or the household debt service ratio was at 7.2%. But where are we now? We're right now at 3.8%, even better than where we were back in the 80s and 90s. So are we seeing people over-leveraged or taking on lots of debt like back in the housing crisis? Definitely not. We're in a very different situation now. And why is this so? This is due to rising wages and low interest rates that we've had for many years. Yes, we've had recent rise in interest rates, but historically, where we are is still considered a good rate. Now, we also need to look at cash out refinance numbers and see how today compares to times during the housing crash. If you look at this graph, this reveals difference in annual mortgage payments for cash out refinances. In other words, how much more they were paying in annual basis aside from their original mortgage payments because they took cash out from their equity. And if you see from 05 to 08, people were paying $3,000 to almost $5,000 more on their mortgage payments every year because they decided to do cash out refinance. And if you compare this to 2020 and 2021 at $66 and $34, there's almost no comparison. Of course, the low interest rates that we've had does play a part in this, but mostly this low numbers represent people harvesting their equity rather than taking it out and spending it. We all learned our lesson from 2008, and where we stand now is we currently have the record high equity accumulated in our homes right now. This is fundamentally different than where we were in 2008. Now let's move on and talk briefly about what we should expect moving forward. If you look at this latest home price forecast from the 7 experts for this year, they're predicting anywhere between 11 to 6%, and their average is at 9%. If you remember from my monthly market report from the beginning of the year, their average forecast was about 5%. And again, I believe they're going to continue to raise this level as we move forward this year. And if we look at this Pulseonomics' latest home price expectation survey of 100 distinguished panel of experts in the housing market, they're also projecting about 9% appreciation for this year, but going beyond, they're projecting more normal rate of appreciation. Next 4 years of appreciation is very similar to what we saw right before the pandemic. That average rate of home price appreciation was about 3.8%. Let's also look into interest rate, which is still the hot topic in the housing market right now. We saw the rate spike up in the first 4 months of this year, and today the rate is at 5.3%. And this is what Bill McBride said what we're about to see. Based on the current estimate for the peak Fed fund rate, 3.25 to 4%, the 30-year fixed mortgage will likely peak at between 5 and 5.7%. There is some variability in the relationship, so we might see rates as high as the low 6% range. This all depends on the inflation and the Fed fund rate, but I don't expect rates to move much higher than the current rate, although 6% is possible. There's lots of things that influence interest rates, and it's certainly not an easy thing to forecast, but it has all to do with the inflation. Because inflation is the enemy of a long-term interest rate. But it's up to the Fed to tame the inflation, so we need to be keeping our watch on that. So I hope I brought you some clarity in seeing how today's market is fundamentally different than 2008 housing crisis. I know making the right real estate decision is important because it's one of the biggest financial decisions you'll be making in your life. That is why it's critical that you are equipped with the right knowledge about what's really happening in the housing market. And I hope I was able to provide that for you today. I'll see you again next month with more up-to-date real estate information. Goodbye.